You know how sometimes you see a headline about a company report and it doesn't quite seem to add up. Like the market feels tough, maybe there are new challenges brewing, but somehow the company just blows past expectations anyway.
Absolutely. Yeah, it's that disconnect, isn't it, between the headwinds everyone talks about and then the actual numbers they put out. Makes you really want to dig in.
Exactly. And that's what we're doing today. We're taking a deep dive into the latest results from Signet Jewelers, the parent company behind names we all recognize, like Kay, Zales, and Jared.
Mm-hmm. We've got your sources right here, and our mission really is to unpack their first quarter for fiscal 2026. We want to understand the strategy they're crediting for this performance and, see what it all tells us about the jewelry market, maybe consumer spending in general right now.
Right. And the big headline right off the bat is they didn't just meet expectations, they actually delivered results ahead of their own guidance, which sent their stock jumping.
Yeah, even though it had been down for the year before that news hit.
And maybe the most telling thing, they felt confident enough to actually raise their outlook for the rest of the year.
Which is quite something, especially when you hear them explicitly talk about potential challenges. Things like new tariffs and what they keep calling a measured consumer cautious, basically.
So the question is how they manage that.
Exactly. How did they pull it off?
Okay, so let's unpack those core numbers from Q1 FY26. What were the headline figures that really point to this beat?
Well, the top line looked pretty solid. Total sales came in at $1.5 billion, maybe $1.54 billion, depends slightly on the source. But anyway, up 2% compared to Q1 last year.
Okay, 2% growth.
But the number that really grabs you, especially for a retailer, is same-store sales.
Ah, the comp sales, right.
Yeah.
That sales at stores open at least a year gives you that clearer picture of underlying performance, doesn't it?
Exactly. And their same-store sales. They were up 2.5% year over year.
Wait, a 2.5% increase? That is a massive turnaround when you think back. Because Q1 last year, didn't they have like an 8.9% decline?
They did, yeah, an 8.9% decline. So that contrast is, well, it's really stark.
Huge shift.
It absolutely is. Signals a pretty significant change from last year's trajectory. And it wasn't just sales. Their profitability metrics looked better, too. Adjusted operating income was strong, $70 million.
$70 million, okay.
Which is up more than 20% from the $57.8 million last year. And that also beat what the analysts were expecting.
Okay. And hitting the bottom line, their adjusted earnings per share, the EPS,
came in at $1.18. That's up from $1.11 last year. And again, beat the analyst estimates, which were hovering around $1.03.
So solid beats all around then. Sales, operating profit, earnings per share. No wonder the market reacted positively.
Right. And they made a point of saying this performance was, comfortably above the guidance range they'd previously set. Suggests it wasn't just a fluke. Maybe their efforts are genuinely starting to pay off.
Which brings us neatly to the how. What did they say is driving this? Seems like it all centers around this strategy they call Grow Brand Love.
Yes, that's the big one. Their core initiative. They describe it as being in its early innings, just getting started, really.
It is, yeah.
But they believe it's already delivering results. And it's built on three main pillars, three things they're trying to achieve.
Okay, what are those three imperatives?
So first, shifting to a really distinct brand mindset, making sure Kay feels totally different from Zales and Zales from Jared, really separating them.
Got it. Brand distinction.
Second, growing their core business. For Signet, that's always been bridal jewelry, engagements, weddings, that sort of thing.
Right, the traditional core.
And third, expanding into what they call adjacent categories, which mostly means fashion jewelry.
And this isn't just talk, right? They've actually, restructured the organization to back this up.
That's right. They've reorganized things to better integrate, say, digital capabilities and tech to make the strategy actually work on the ground.
Makes sense.
And that focus on the big three, Kay, Zales, Jared, it's crucial. They shared a really interesting stat, actually.
Oh, yeah.
Just 1 percentage point of comp growth in those three big brands combined has the same financial impact as 6 percentage points of growth across all their other smaller banner.
Wow. Okay, that really highlights the leverage they get from those main brands. Huge difference.
It really does. And those three combined, they showed a 4% comp sales growth in Q1. And they also mentioned those positive trends kept going into May.
So the strategy is working there. And it involves specific plays for each brand.
Right. They gave some examples.
Like, what did the sources say?
Okay, well, for Zales, they're really pushing their own IT campaign. It's less about the traditional big moments, more about customers buying jewelry for themselves. everyday wear.
Self-purchase.
Yeah.
Interesting angle.
Yeah, and focusing on more accessible price points, designs that fit current trends, like, stacking rings. They mentioned collections like Stellar Allure and Wimley.
Right.
And they're even trying out new stuff, like different store formats, even marketing on, mobile gaming platforms.
Okay, so Zales is leaning into that accessible, self-buy fashion space. What about Jared? Different vibe there.
Totally different. Jared's positioned higher up, aiming for that kind of aspirational luxury feel. They're launching a new fashion campaign there, building on collections they already have that are doing well.
Okay.
And a key point they made about Jared, they significantly cut back on promotional discounting, over 20% less discounting than Q1 last year.
Reducing discounts. That's usually a strong sign, isn't it?
Right.
Suggests they feel the brand and the product can stand on their own without needing constant sales to drive traffic. Points to real brand equity building.
Exactly.
And K, where does K fit in? Still the traditional gifting spot.
Pretty much, yeah. Kay remains that go-to for romantic gifts, milestone moments, but they're also bringing a new fashion product for women and men.
Okay.
And like Jared, Kay is trying to reduce how much they rely on promotions. They want to attract customers with new designs, refreshed digital experiences, better in-store vibes, that kind of thing.
So less about the big sale banner, more about the product and experience.
Right. And they said they saw real traction with that approach in May, improving both the number of items sold and the profit margins on those items.
Okay, so boiling it down. Distinct brand identities, new product, pulling back on promotions where possible. And they're saying this strategy is driving that brand distinction, leading to sales growth, an increase in average unit retail.
AUR, yeah. The average price per item sold.
Right, AUR, and expanding their merchandise margin too.
Precisely. And that increase in AUR, which is about 8% overall, they see that as a direct result of getting the product mix right for each specific brand strategy. Not just raising prices, but selling the right stuff.
Let's dig into that product mix a bit more then. You mentioned bridal is core, but fashion is the big expansion opportunity. How did bridal actually do in Q1?
They reported a continued movement up and to the right, which is corporate speak for things are getting better.
Right, good direction.
They feel they're gaining traction because they have a good selection at the key price points and styles people want right now. And that apparently delivered unit growth in engagement rings, a modest increase in the average bridal item price, and expanded margins for the category.
And they're managing that mix between lab-grown and natural diamonds in bridal. Seems like a tricky balance.
Yes, they are. And they seem to believe their strategy there is actually helping them gain market share specifically in bridal.
Okay. What about the fashion side? You said that's where they see a much bigger potential market.
Yeah, multiples larger than bridal, absolutely. And fashion showed really strong improvement from the previous quarter. It actually turned positive comp in Q1.
That's a significant shift.
It is, and it was especially driven by improvement in those key gifting price points, the $250 to $500 range. They said new collections they launched were key drivers, helping performance around Valentine's Day and through the whole quarter.
Now, lab-grown diamonds, LGDs, how are they fitting into this picture, especially in fashion? We hear so much about them.
LGDs are becoming, really significant for Signet. Overall, about 20% of their total sales now involve lab-grown diamonds. That's up around 5 percentage points just from last year.
20%. Whoa.
In bridal specifically, it's roughly a third of sales, mid-30s%, also up from last year. But the really explosive growth, the number that jumped out, was in LGD fashion sales, up 60% in Q1.
60% growth. In LGD fashion, that's huge.
It really is. And they noted that these LGD fashion pieces, they carry a more than 2 times AUR premium compared to the average price for other items in the fashion category generally.
Okay, wait, so LGDs in fashion actually have higher average prices than other fashion pieces?
Yes.
Yeah.
Which is a big reason why their overall fashion AUR improved, alongside other factors like higher gold prices, of course.
Huh. Does that work? I thought LGDs were getting cheaper.
They are, but here's the interesting part they explained. The lower cost of producing lab-grown diamonds means they can offer, say, larger stones or more intricate designs at price points that still feel accessible compared to natural diamonds. So it kind of expands the use case for diamonds.
Ah, so people are maybe trading up. Instead of buying a non-diamond fashion piece, they can now get a diamond piece, even if it's lab-grown.
Exactly. It creates a trade-up opportunity. That Wimley collection at Zales using LGDs for everyday wear is a perfect example.
Okay, but what about that price deflation we hear about with LGDs?
Yeah.
How does that fit with them driving up their average unit retail? Seems contradictory.
It does sound it at first, doesn't it? And yes, LGD prices are still deflating, although they did say the pace of that deflation has slowed down.
Okay.
But the key insight here is this. While the price per carat might be falling, consumers are using that affordability to buy bigger stones than they would have previously, or maybe upgrading to a better quality LGD.
Ah. So the overall ticket price for the piece goes up, even if the per carat cost is down because the stone itself is larger or better.
Exactly. That trade up in size or quality is more than offsetting the lower per carat costs, and that's what pushes the average unit retail price for LGD pieces higher.
Got it. That makes sense now. Clever dynamic.
Yeah. And they also pointed out that unlike natural diamonds or commodities like gold, the input costs for LGDs are, more controllable for them. Things like the design, the fabrication, the timing, those are levers they can pull more easily.
Okay, let's switch gears slightly. Let's talk about those headwinds you mentioned right at the start, tariffs and the consumer environment. How are they handling the tariff situation? That sounds potentially tricky.
It's definitely a moving target right now. Signet imports most of its stuff, mainly finished jewelry. About half comes from India, and then a high single-digit % from China.
Okay.
The current focus seems to be on an additional 10% tariff that's primarily hitting goods coming from India right now.
Right. So what steps are they actually taking to manage that?
Well, they said they've got a dedicated task force meeting frequently. They're optimizing production schedules, looking at when they receive products. They're also actively evaluating different countries of origin for sourcing.
Looking for alternatives.
Yeah, they actually seemed pretty confident they could move most of the manufacturing currently done in China or find alternatives before we even get to the holiday season this year.
That's quite a claim.
And they're also leaning on their scale, their relationships with suppliers to navigate this.
So how do they plan to absorb the cost? Are we going to see prices go up?
They seem to expect that they can manage the current tariff impacts within their existing full-year guidance. Their plan involves a few things. Vendor negotiations, basically pushing back on supplier pricing. Value engineering, which means redesigning products slightly to make them cheaper to produce.
Okay.
And also managing promotions and the life cycle of their products. They didn't explicitly say we're raising prices across the board, more like they'll try to use these other levers first.
Got it. And on the consumer side, you said they described the environment as measured or dynamic. What does that translate to for their strategy?
It basically means consumers are being thoughtful, maybe a bit cautious with their spending. But Signet's take is that for things consumers really want and see value in, that desire to buy is still there.
So not necessarily trading down across the board.
Not necessarily. They emphasize that their increase in average unit retail isn't just because they slapped higher price tags on everything. It's about having the right products, the ones that align with trends and meet what consumers are looking for in terms of design and need. If they offer that perceived value, even cautious consumers seem willing to spend.
Interesting. Okay, let's look under the hood a bit. Their financial health, how they're managing money. How did their costs look this quarter? Margins.
Looked pretty well managed. Their gross margin rate profit after the cost of the goods themselves actually expanded by 100 basis points, so 1 full percentage point, up to 38.8%.
And what drove that improvement?
They attributed it to that refined promotional strategy we talked about, better inventory management, and also getting leverage on fixed costs like store rent because overall sales were up.
Okay. And their operating expenses, things like marketing, admin, payroll, the SG&A rate.
Their SG&A rate was basically flat compared to last year at 34.1%, which was actually better than they had expected.
How come?
They said it's thanks to cost-cutting actions they took earlier as part of that reorganization, plus just ongoing discipline in spending. Their inventory level looks healthy too, about $2 billion, only up 1% year over year, which is actually less than their 2% revenue growth. Gives them good flexibility.
And they have a strong cash position too, right? Over $260 million in cash and total liquidity cash plus available credit of $1.4 billion.
Yep, strong balance sheet.
And they've been putting some of that cash to work, returning it to shareholders, especially buying back their own stock.
Oh, very actively. Year to date, they've repurchased about 2.3 million shares. That's over 5% of all their outstanding shares gone.
5%. That's significant.
It is. They used their available cash and explicitly said they took advantage of the stock price pullback earlier in the year. And they still have nearly $600 million left on their current buyback authorization.
So room for more. And they also kept the dividend going.
Yep. Declared their regular quarterly dividend, 32 cents per share. Their priorities seem pretty clear. First, invest in organic growth, growing the business. then return capital to shareholders, and do all that while keeping debt levels pretty conservative.
And that approach seems to be getting noticed. Didn't Fitch upgrade their credit rating?
They did, yeah. Fitch recently upgraded them to investment grade, kind of a validation of that financial discipline.
So, healthy financials,
Yeah.
clear plan for cash. They're also making some pretty big moves with their physical stores, their real estate footprint, aren't they?
Yes, definitely. They outlined a four-part strategy for their real estate. It's all about aligning the store experience with each specific brand's identity and, frankly, moving away from less productive locations.
Okay, what are the 4 parts?
First, they plan to close up to 150 underperforming stores. These are mainly in malls where the leases are coming up for renewal anyway. They closed 14 in Q1 and expect to close just under 100 for the full fiscal year.
So, closing underperformers. Part 1.
Part two is making sure they capture the sales from those closing stores, trying to get those customers to shop at other nearby Signet stores or, importantly, online. Sales transference, they call it.
Right. Keep the customer.
Part three involves repositioning stores that are actually doing okay, healthy stores, but they happen to be in declining menus. Maybe a mall that's just losing traffic overall. They plan about 10 of those this year, but potentially up to 200 over the next 3 years, moving good stores to better spots.
Okay, and the last part.
Just continuing to refresh the rest of the fleet. Renovating stores, they did about 40 in Q1, planning around 160 for the full year. Keep things looking current.
This definitely sounds like a conscious shift away from relying so heavily on traditional enclosed malls.
Oh, absolutely. They said their revenue coming from North America malls is down to about 35% now, and they're aiming to get that down to 30% in the next few years.
And does all this moving and renovating cost a lot extra?
Apparently not. They said they don't expect the strategy to require a big increase in their normal capital spending levels.
Okay. How are the digital channels doing alongside all these physical store changes? E-commerce.
Pretty well, it seems. The core brands, Kay, Zales, Jared, all saw strong double-digit e-commerce sales growth in Q1.
Double digits, nice.
Blue Nile, which they acquired a while back, is apparently seeing consistent positive sales growth now that they've sorted out some earlier technical integration issues.
Okay, good.
James Allen, though, another acquisition focused more on value custom rings. That one's still underperforming.
What is that?
They think it's mainly due to lower brand awareness compared to their big names, and maybe its specific positioning in the market. They said they're taking aggressive actions there, refining marketing, holding more finished product ready to go, taking a deeper look at the brand itself.
So, still some work to do on James Allen.
Got it. Okay, bringing this all together then. Strong Q1, strategic progress. What does this mean for their outlook? How's the rest of the year shaping up according to them?
Well, based on that Q1 beat and their confidence in the strategy, they actually raised parts of their full-year guidance for fiscal 2026.
Raise guidance, okay.
Yeah, they increased the low end of their total sales forecast. The range is now $6.57 billion up to $6.80 billion. They also raised the low end of their adjusted operating income guidance. That range is now $430 million to $510 million.
So higher floor on sales and profit expectations, and I assume that translates to a better earnings per share forecast too.
It does. They raised the midpoint of their adjusted EPS guidance by about 4%. The new range is $7.70 to $9.38 per diluted share. That's up from the previous range. And that reflects both the improved operating outlook and the impact of buying back all those shares we mentioned earlier.
Right, fewer shares boosts the EPS number. Did they give any guidance for the current quarter, Q2? They did. For Q2 fiscal 26, they're expecting sales between $1.47 billion and $1.51 billion. Same-store sales are projected to be somewhere between a small decline of 1.5% and a slight increase of 1%.
Okay.
But interestingly, they noted that quarter to date, so into Q2 already, their performance is running near or even slightly above the high end of that comp range. So continued improvement sequentially. They specifically mentioned positive trends around Mother's Day, too.
So despite those tariffs, despite the measured consumer, management sounds, well, pretty confident.
They really do. They wrapped up by reiterating confidence in their ability to manage the levers they can control, strategy, inventory, costs, and to execute well even if the market backdrop is dynamic. They fully expect to navigate the current tariffs within that updated guidance and keep driving sustainable growth by sticking to their plan.
Okay, so let's try and wrap up this deep dive. It sounds like Signet really delivered a strong Q1 beat. A lot of that seems driven by this grow brand love strategy starting to gain traction.
Yeah, showing results in both the core bridal business and that expanding fashion category. And it seems lab-grown diamonds, especially in fashion, are providing a really significant boost there.
Right. And meanwhile, they seem to be actively managing those initial tariff impacts, not letting it derail them yet, and signaling quite a bit of confidence by, raising their full-year outlook and buying back a pretty hefty chunk of their own stock.
It's a really fascinating picture, isn't it? You've got a company in a very traditional retail sector jewelry trying to juggle so many things at once, evolving consumer tastes, shifting how and where people shop with physical stores and digital, managing complex global supply chains.
And all while trying to double down on making their big brands feel really distinct and separate. Kay is not Zales is not Jared.
Exactly. This deep dive really kind of highlights how interconnected all those moves are. Makes you wonder, what is this really intense focus on creating distinct brand identities, especially for Kay, Zales, and Jared? What does that tell you about the future of retail, particularly for these kinds of considered purchases like jewelry?
Yeah, and maybe. How will that balance between forging a strong brand connection, making someone want that K piece specifically, versus just offering straightforward value?
Yeah.
How does that balance evolve in this measured consumer environment they keep talking about?
That's the key question, isn't it? Brand versus value in cautious times.
Hmm.
Definitely something to think about.